Hi, welcome to the third edition of the Kiwi DIY Investor. Today we'll be looking into what is a share and why should I become a shareholder. So the usual disclaimer, this video is for informational purposes only and doesn't constitute financial advice. If you're unsure, please contact a registered financial advisor, and I may have positions in some of the stocks mentioned in this video series. So what is a share? A share is an ownership stake in the company. Shares can also be called stocks or equities. They're all one and the same. When you buy shares, you're becoming a part owner in the company. The more shares that you own, the greater your percentage of ownership of that company. And owning shares entitles you to vote in resolutions proposed by the directors. One share gives you one vote. And this will usually consist of voting for re-election of directors and their pay. But unfortunately, small investors like myself don't usually have enough shares to influence the vote. Owning shares also entitles you to any dividends that the company might pay. So there's three usual types of share owners. Insiders, so this is directors, founders, and staff of the company. So in small companies, usually these insiders make up the majority of shareholders. As companies grow, more and more institutions might become interested in them. This includes funds like superannuation providers and investment banks. And the third type of common shareholder is retail. This is individual investors like myself. So why can I only buy shares in some companies? Companies that can be bought on stock exchanges are called public companies. These companies at some time raised money from the public. So when a company is small, usually they're funded by the founder or someone within the founder's business network who's willing to put money into that company. So at that point, the company will be a private company, even though there might be shareholders. There's no way to easily buy or sell shares. As the company grows, they might want to invest in new employees or new machinery, or even one of the founders or investors might want to cash up their investment. At that point, their choice is to reach out to other private sources, maybe angel investors or private equity, who might want to invest in the company without doing it through a stock exchange. They can try and borrow from the bank, but often banks are reluctant to lend to smaller companies who are yet to make a profit. And the third option is to do what's called an initial public offering, or IPO, and that's when you list on a share market. So usually you'll do this, you'll make a prospectus saying how much you want to raise, and that'll be a booklet outlining what the company does, how the company has performed to date, how much you're trying to raise, and what you're going to do with the money. So usually you engage an investment bank to go and raise money for you. So they'll reach out to their network and give the prospectus to stockbrokers and funds and try and raise the targeted amount of money you want. If successful, then the company will be listed on a public exchange. And at that point, the shares can be bought and sold into perpetuity. So anyone who wants to sell from that point can put their shares up for sale, and if anyone wants to buy more, they're welcome to buy and sell, and that'll continue on forever unless someone buys all the shares and takes it private. And not all companies need to do this. Some current examples of really big companies that haven't needed to go public, Uber and Airbnb, they've just been really successful, and whenever they need money, they seem to be able to easily raise it from private sources without needing to IPO. So why buy shares? Shares have the potential to increase in value over time, but can also decrease. Some shares also provide income in the form of dividends, and that's usually annual or biannual payouts of a percentage of their profits to shareholders. Shares historically have a better return than bonds or keeping money in the bank. The reason for this is um, shareholders take on the most risk. So if a company were to go bankrupt and the liquidators were to be brought in, shareholders only get paid what's left after all the tax department, employees, lenders such as banks, and other creditors have been paid off. So they're last in line to receive whatever's left after everyone has been satisfied. And because of this, because they're taking on the most risk, theoretically they should also get the most reward over time. So let's look at the historical performance of the NZX. I've got a 10-year graph up on the screen. And the interesting thing about this is this includes the Great Recession of 2008. So you can see the very beginning of the graph, that's 2008, and you can see it goes down a bit. But even considering this, it's been mostly one-way traffic on a longer-term trend. You can see there's been a few downwards movements, but over this period, the average return has been 5.62% annually. And over the past 5 years, it's been even better than that, where it's averaged 10.45%. So if you've invested in general, you would have done quite well over this period. Some shares have done a lot better than that. So I've got two examples up on the screen. Basically, this is why I invest. I'm trying to uncover these companies when they're little. So Fisher & Paykel Healthcare and A2 Milk Company, if you look at the graphs, you can see it's pretty much one-way traffic. So these are, I think they're 5-year graphs, just showing these companies have gone from being pretty small companies over this time to really increasing in value, and people that had identified these companies early enough and continued to hold would have done really well. So ultimately, that's why I try and invest. I look at the small end of the market, the small and mid caps, and try and identify the next Fisher & Paykel Healthcare or A2 Milk Company and ride that share price up. So next time, we'll be looking into the first case study. So it'll be why I invested in a particular company at $1.46 2 years ago. We'll be looking at the most recent earnings release. What do I look at when I'm reading these, and to determine whether I should continue to hold even though the share price is up 100%. So that's this edition finished. So look forward to you viewing the next one. If you've got any comments, please put them in the comment section. And if you like this, please follow me. Thanks.